Hi there, I'm David Cross. I'm the owner of U.S. Asset Management in Duluth, Georgia, and today we're going to be talking about our current observations for what's going on in the markets and the economy in December 2022. We'll be looking at the economic data, including interest rates, inflation, current trends, and possibly what to do right now. These are our disclaimers. Please take a moment to review them. As everyone's aware right now, interest rates have really spiked up quite a bit this year. What most people don't understand is that it's been the biggest and the fastest jump in decades. After being at 0% earlier this year, 2-year treasuries are up around 4.5% right now. Even money market rates have jumped up significantly. The current money market is at 3.36% right now, and the higher balanced money market is around 3.8%. Of course, the prices and yields are subject to change without notice. Nothing's guaranteed, but it's still a significant jump from near zero earlier this year. Treasury bond rates have also jumped significantly. From, again, being near 0% earlier this year, we're now at the point where you can buy August, September, October, November bonds that come due less than a year from now, and you're making well over 4.5% right now. Interest rates on mortgages are also up significantly. This is just an example. I know not everybody can live in $1 million homes and that kind of thing, although they're becoming more and more common. But if you were a potential buyer in January of this year and you had a budget of $5,000 per month and you put down 20%, your interest rate was 3.5%. At that point in January, that $5,000 monthly payment would have supported a purchase price of around $1.4 million. Now with interest rates at around 6.5%, depending upon the day, that will only support a home price of roughly around $1 million. So there's a $400,000 decrease, or about a drop of about 29%. And while you probably haven't seen that drop reflected in the price of the homes in your neighborhood, I do think that you're going to see significant softening or decrease in home values in a lot of people's neighborhoods. So just be prepared. Inflation, as measured by the Consumer Price Index, or CPI, surged to 6.6%. That's a 40-year high, according to Bank of America. And while that number is fairly high, I think the truth is probably a little bit higher than that. So inflation, as measured by the United States Bureau of Labor Statistics, is actually a little bit higher, I think. According to their calculations, all items are up 7.7%. Food is up about 11%, energy is up about 17.5%, and we're going to see about a 10% increase in Social Security benefits for the 70 million Americans that receive Social Security starting in January 2023. So this is the largest increase I've ever seen in my career. So let's play the inflation game for just a second. In 1977, do you have any idea how much a postage stamp was? 13 cents. Today, postage is 60 cents. Speaking of 1977, let's just take a moment and look at this Saturday Night Live clip about inflation.
Inflation is our friend. For example, consider this. In the year 2000, if current trends continue, the average blue-collar annual wage in this country will be $568,000. Think what this inflated world of the future will mean. Most Americans will be millionaires. Everyone will feel like a big shot. Wouldn't you like to own a $4,000 suit and smoke a $75 cigar, drive a $600,000 car? I know I would. But what about people on fixed incomes? They have always been the true victims of inflation. That's why I will present to Congress the Inflation Maintenance Program, whereby the U.S. Treasury will make up any inflation-caused losses through direct tax rebates to the public in cash. Now you may say, won't that cost a lot of money? Won't that increase the deficit? Sure it will. But so what? We'll just print more money. We have the papers, we have the mints. I can just call up the Bureau of Engraving and say, hi, this is Jimma. Roll off some of them 20s. Print up a couple of thousand sheets of those century notes. Sure, the glut of dollars will cause even more inflation, but who cares? Everybody will be a millionaire.
So now what you're seeing is where inflation comes from. It's caused by our government and their inability to rein in spending. And they don't ever want to tell the American voters, no, we can't afford that. No, we have to tighten our belts. So what do? They just print more money. So you're looking at a chart that goes back to 1960 of the United States M3 money supply. M3 money supply is the dollar bills that are in your checking account, the dollar bills that are in your wallet, and it's all the currency that's in circulation. And what you can see is that the number is so low you can't even read it. To right now, we are up around $22.5 trillion, and a lot of it has just been created very recently. This chart shows just the past 10 years. So 10 years ago, the United States government had a little over $10 trillion of currency in circulation. Now, again, as I said, we're up like around $22 trillion right now. So it's more than doubled. Over 10 years, that means that the money supply has been increasing at roughly 7% per year. You've probably seen in the news and you've heard the White House tell you that the American consumer is resilient. They're doing okay. People are buying things. What they don't tell you is that they're using credit cards to buy things. So credit card balances right now are at an all-time high. Meanwhile, credit card delinquencies are increasing rapidly. And while they were historically low in 2021 because there was so much COVID relief money that was out there, that money stopped flowing, and so credit card delinquencies are increasing rapidly. One of the most concerning statistics I've seen recently was in June, there's a survey that's done by Alignable that says that the number of small businesses that could not pay their rent in full or on time in June was 35%. November rent, that number went to an astounding 41%. I don't think it's ever been that high, but it's mind-boggling that there's so many small businesses that are struggling right now. And I think a lot of it has to do with the fact that we're seeing more inflation than people are really anticipating. Meanwhile, existing home sales are slowing very rapidly right now. It's been the fastest slowdown in the history of existing home sales data. So you can tell the red line is where we are right now, and it's just dropped off a cliff. A lot of that has to do with the fact that consumers are stretched, I believe, and also because interest rates are significantly higher than where they were in January. For anybody who has a balanced portfolio, and that means you've got some kind of mix of 60% stocks and 40% bonds, and it's supposed to do well in all environments, this year has been the worst year ever for the returns on that type of portfolio. So it's going to take a different strategy for how to invest, I think, going forward, especially since interest rates were declining for so long and inflation was declining for so long, and now interest rates and inflation are going the opposite direction. So stocks have been weak in general, but we're seeing what I would call tech wreck 2.0. So the chart you're looking at right now shows us what's happened with technology stocks relative to the S&P 500 and how they're performing. And for a long time, they went up and up and up. And now what you're seeing is the red line has turned over, things are coming down, and I think this is probably going to be one of the worst years in history. I'll show you an example on the next slide. So here's a prime example of the tech wreck 2.0. So Carvana is a car company that is tech enabled, that was really doing great things, and people enjoy the company's ability to be able to deliver a used car to their home, and that was tremendously beneficial when COVID was going on. Now that things have kind of freed up a little bit, people just aren't buying as many cars right now because they don't have the cash that they had from the stimulus that we had before. Carvana stock peaked at 350 in the early fall of last year, and it's fallen from $350 a share to $4.32. And for all we know, it could be on its way to zero. So the question I get most often is, are there still good opportunities out there? Mark Twain really said it best. He said, history doesn't repeat itself, but it often rhymes. I've been willing to spend a fair amount of time to go back and read old newspapers from the 20s and 30s and kind of relive history and see what worked at the time. So we're applying some of the things that we've learned there and melding it with what we're seeing today and the different economic environment that we're in today and the different investment vehicles that are available to us today. So what should you be doing right now? Honestly, hope for the best, prepare for the worst. We're telling folks right now that it looks like there's still storm clouds that are gathering on the horizon right now, so we would reel in your expenses right now. There are some businesses that have almost just shut down, particularly in real estate and financing. There's a lot of difficulty that's being felt right now in that particular industry, and that's probably going to spill over at some point to other industries. So we need to adjust to the new reality fast. And if you have adjustable rate debt, you need to do everything you possibly can to eliminate it, because I honestly don't know how high interest rates can go. But I do know from experience, interest rates and inflation and stocks, they all go higher than you ever think they will, and they all tend to go lower than you think they will, and it tends to go on for longer than you think it will. And sometimes markets bounce around quite a bit, so you need to be prepared. If you'd like to learn more about our approach and how we might be able to help you, I invite you to come and visit us either online or with a digital appointment with Zoom or Teams, or you can visit us at our offices at One Sugarloaf Center. We have beautiful offices over here, mainly because my wife is the one that decorated them, and she did a spectacular job. So we get a lot of compliments about things. It's a very comfortable environment. We invite you to stop by anytime. Our job is simple, and our credo is simple. Our job is helping you make better decisions with your money. Check us out online at www.us-am.com.